Traders, I want to head on over to the floor of the CME Group where we have Scott Bauer. He's the CEO of Prosper Trading Academy, is joining us this morning. Scott, welcome. Not the kind of start to the week that investors were hoping for. A bit concerning to see U.S. indices limit down as we head into the open, Scott.
No doubt about it. And, I just want to mention Stephanie Lewicki just did an amazing job explaining, everything that you guys went through. So, that's something that was, I think, just fantastic for your listeners. That being said, yeah, I mean, where do we go from here? We don't know with the sets being in place or with the stops being in place right now. You look to the ETF market and see that we're probably down another 1.5% to 2% really than where futures are indicating at this moment.
Scott, in terms of price, where do we go from here is a good question, but in terms of expectations from the Fed, I think it's pretty clear where we go from here, and that's lower in terms of rates. I mean, right now it seems like the Fed's expected to cut potentially as much as 1% by the next meeting, the FOMC meeting. Talk to us about what you think is going to happen here, because at a certain point, we're talking about heading to zero or potentially even negative, and they've been pretty clear that's something that they're somewhat opposed to.
There's already been some news out this morning about them increasing the amount of repos, and I think that they really have to think long and hard about some fiscal policy today other than lowering rates today in a panic or tomorrow in a panic, because as many know, with the cut that we got last week, they're almost out of bullets, Ben. So
yeah.
they really have to, think long and hard about, okay, they need to do something to calm the markets. They need to supply liquidity, but what can they do as opposed to just lowering rates, which we know is going to happen?
Yeah, and it seems like, Scott, they need to do something to protect some of the businesses that are going to be most hardest hit by some of these. For example, the energy producers. I mean, without some sort of support somewhere, we're going to start to see some bankruptcies, it would seem like, at some point. I mean, these producers are coming under pressure in a big way.
No doubt. You're going to see some consolidation in that space real quickly, in my opinion, here. And, the debt levels that they have are not going to be able to be serviced. And, yeah, the Fed's going to have to come up with something. I don't know what that something is. I'm not sitting in their chair, fortunately. Yeah. But you're right. It's going to get ugly. It's going to get really ugly.
Scott, that's something, and that unknowns in terms of what that's going to be seems to be weighing on the U.S. dollar. We're certainly seeing rates coming off and the impact that that's had on the U.S. dollar. It's interesting because this first time in years, it seems like we've been watching that correlation come back into line. Some of this is tied to, we're going to take a look at a couple charts in just a few minutes, but some of this is tied to, well, the weakness we're seeing here in the U.S. dollar is tied to some of the foreign currencies bid that we've been seeing, the yen, the Swiss. Scott, even the euro currency is starting to see a little bit of a bid come back into play.
Yeah, even the euro, you're right. And, what's happening is people are dumping the dollar now as U.S. yields are just plummeting towards zero. The dollar is the lowest since September of 2018, trading just above 95. And, I don't want to say the biggest surprise, but like you just mentioned, the euro is trading higher, and the volatility, Ben, in the euro. So in the euro dollar, the volatility is the highest that we've seen in the last 3 years.
Wow.
So, I would expect in the short run, we'll probably see a continuation of the euro higher versus the dollar.
Yeah, I'd imagine that the ECB has got to be kind of frustrated a little bit by the timing of this coronavirus, because we've been seeing the numbers coming out of Europe for the most part, which have been signaling that prior to coronavirus concerns, things were starting to turn around for them a little bit. Factory orders last week, Scott, I'm sure you saw up 5.5%. German industrial production this morning came in up 3%, well above the 1.7 they were looking for, but prior was down 2.2%. So again, signaling that they could have kind of turned the corner, so to say, into this. Scott, where do we go from here? I mean, what's the focal point? Because keep in mind, one of the things that was buoying the U.S. dollar was the rate differential that we had been seeing. Now we've got the U.S., which is lowering rates at a more rapid rate than any of its counterparts. I guess that sort of moves away or takes away some of that luster, some of that lure, some of the attraction to the U.S. dollar, and ultimately you can see why we're coming off a bit, and ultimately why some of the foreign currencies like the euro, as you just mentioned, and even the pound, for example, are seeing a bit of a bid relative to the greenback.
Well, it's a catch-up that's been long overdue for the last year, maybe even 18 months or so is what we're seeing. So, if you look at it, and it's very difficult to do this, Ben, because everybody wants to, know what's happening in the here and now. But if you look at it in a more macro picture, like you said, things are coming back into line. I don't know if that's good, bad, or indifferent for right now. And when I say right now, this we're talking minute by minute here, maybe hour by hour, not day by day, week by week. The dollar is under severe pressure, and it's probably not going to stop. However, I believe there is light at the end of the tunnel. And just like you were talking about with the euro data that we've seen over the last few weeks, and even the German factory orders, you know what? They did start to make a little turnaround. Yeah. Timing is everything, right? The coronavirus, hitting right now and just giving them another gut punch they don't need is awful, but maybe there is some light at the end of the tunnel here.
Scott, talk to us about what you're doing personally to avoid some of the pitfalls that are, so present when we see this extreme volatility and wide range trades that we've been seeing, panic type selling coming into play. Can you talk to us about not only what you're doing personally, but what you're telling your clients, your investors, what they should be doing?
Absolutely, Ben, and it's such a psychological market. It has been for weeks and weeks and weeks, and very difficult for people to remove themselves out of the I don't even want to call it a panic mode, but oh my God, I've got to do this because something's going to happen in the next hour.
The FOMO mode, almost fear of missing out.
Right. Yeah. Exactly. That's the most difficult thing to do. And I think what most, especially retail traders have to do, or retail investors have to do right now, is define a clear line between an investment and a trade. You want to make a trade? Okay, have the mindset of a minute, an hour, a day. But don't make decisions about investments based on that same mindset. Yeah. And it's a very, very difficult thing to do. I'm not a psychologist, but the psychology of trading right now maybe has never been at its high point, except maybe during the financial crisis.
Scott, I'm feeling it personally as well. I'm glad you brought up the fear of missing out kind of mentality that we get sucked into, because oftentimes we forget about some of the potential risks that are out there. They're certainly heightened as well. We focus on all the opportunity that's presenting itself, but we need to remind ourselves and stay grounded in terms of some of those risks. Scott, a great breakdown. Thanks for reminding us of how emotional we can get during these times, and thanks for helping us take a look at some of the recent price activity. Trader Scott Bauer, the CEO of Prosper Trading Academy. I said take a look at the recent price activity.